Over the last 10 episodes, we've covered every major entity structure. We've gone through the tax treatment, the compliance requirements, the cost, and the risk of each one. The most important thing I can tell you after all of that is this: there is no best entity. There's only the one that matches where your business actually is right now. Today we're tying everything together into a framework, and then we're covering the most common mistakes when transitioning between entity types. Because choosing the right structure matters, but getting the transition right matters just as much. Welcome back for the season finale. I'm Lauren Twitchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent. This episode is where the knowledge becomes a decision. We're going to walk through 5 stages of business growth, match each one to the entity structure that typically fits, and then talk about what goes wrong when people change structures without proper planning. Stage 1, testing the idea. You're proving the concept. Revenue is low, the sole proprietorship is the appropriate structure. Zero formation cost, total simplicity. The trade-off is no liability separation. Your record should still be professional from day one. Stage 2, growing income and increasing risk. Revenue is consistent. You have personal assets to protect. The single member LLC creates the legal separation. Tax treatment doesn't change. You're still on Schedule C. The value is in the liability protection, not a tax benefit. Stage 3, consistent profit and operational discipline. The break-even math works. Your bookkeeping and systems can support payroll, a corporate return, and the compliance requirements. The S-corp election is on the table. If your profit is consistent or your books aren't current, the election can wait. Stage 4, scaling, reinvesting, or building toward an exit. You're retaining most of your profit. Stage 4, scaling, reinvesting, or building toward an exit. You're retaining most of your profit. You're raising or planning to raise outside capital. You're building toward a high-value sale. The C-corp offers retained earnings at a lower rate, the stock structure investors require, and potential QSBS benefits. Stage 5, multiple owners. Whenever there's more than one owner, regardless of size or maturity, the documentation requirements are the highest. Agreement, capital accounts, basis tracking, separate return, K1s. The principle that ties all of this together: operational maturity over revenue. I don't tell clients to switch when they hit a certain dollar amount. Revenue is a data point, not a trigger. What matters is whether the business can support the requirements of the next structure. Can you maintain a separate bank account and operating agreement? Then the LLC is manageable. Can you run payroll consistently and document reasonable compensation? Then the S corporation is on the table. Can you maintain corporate governance and manage a board structure? Then the C-corp is feasible. A clean sole proprietor with organized records is in a stronger position than a messy S-corp with missed filings. The structure you can maintain well is always better than the structure you can't. Now let's talk about what goes wrong when people change structures, because the transition is where most of the expensive mistakes happen. The first issue is timing. When you change your entity structure mid-year, you create 2 distinct tax periods within the same calendar year. You have to close the books on the old entity as of the transition date and open new books for the new entity. The 2 periods can't be blended. Most mid-year transitions break down because the owner doesn't close the books on the old entity, the bookkeeping continues as if nothing changed, and the tax professional has to reconstruct the split after the fact. That's expensive and introduces errors. The simpler approach, when possible, is to time the change to January 1st. One structure for the full year, one set of books, one return. The second issue is the payroll gap after an S-corp election. The owner files Form 2553, the election is approved, and then nothing changes operationally. They don't set up payroll, they keep taking draws. The moment the election is effective, you're an employee. Payroll should be running from day one. If you don't, you create multiple problems simultaneously. No reasonable compensation, potential reclassification of draws as wages, failure to deposit penalties, failure to file penalties for the ones you didn't submit. Before your election takes effect, have your payroll system in place. Don't file the election until the infrastructure is ready. The third issue is operational carryover. Using your old bank account from the new entity temporarily, carrying forward a verbal partnership agreement when the entity structure changes, operating the new structure with old habits. The new entity needs its own bank account in the entity's name before the first transaction runs through it. If you're restructuring a partnership, the new entity needs a new operating agreement reflecting the current terms. Every entity change is a fresh start for documentation purposes. The cost of doing a transition wrong is almost always higher than doing it right. A clean transition requires planning, professional support, proper timing, bookkeeping separation, payroll setup. That has a cost, but it's a known manageable cost. A poorly executed transition creates penalties, amended returns, and cleanup fees that compound over time. Here's the bottom line for this episode and for the season. There is no universal answer to the entity structure question. The right structure depends on your liability exposure, your profit level, your growth plan, your operational discipline, and whether you have partners. What I've tried to give you over these 11 episodes is the knowledge to evaluate your own situation, not a shortcut, an understanding of how each structure works so you can make an informed decision or have an informed conversation with the professional who helps you make it. Take an honest look at where your business is today. Does your current structure match your stage? Does your compliance match your entity? If the answer to either is no, that's the gap to close next. Thank you for spending this season with me. I appreciate you staying with it. I'm Lauren Twitchell, and keep the fluff out of your books.